Good morning. You're watching The Market right here on ET Now with me, Aisha Faridi. I've got Nikuj Dalmia, Avan Dabash as well joining in. And this market continues to flatter you, as deceiving as the real parameters of the real economy may be on ground, and the fact that you still don't know what's going to happen with the lockdown, whether it gets lifted on May 4th, whether we see an extension or not. The market continues to be singing its own tune. 9,500 plus, yes, you heard me right. That's the kind of level that we've been sitting on. What a remarkable recovery it has been from those March lows of 7,500 thereabouts. This morning, of course, you've got a whole host of data points as well to focus in on. The US economy has shrunk almost about 4.8%, which is the largest quantum of a GDP shrinkage coming in since the great financial crisis. Jerome Powell says that rates are going to be lower for longer. He says will keep helping in buying assets as and when needed. Early trials are now showing improvements in patients from the Gilead drug. So Nikuj, I guess, there is that hope in the market, at least on a global front, that a drug could be sooner on the horizon than later. And that's really bringing about this renewed optimism in equity markets around the world.
Aisha, I'm surprised. I'm surprised with the strength what local markets and global markets are reporting. And it's not that I'm surprised. Most of the market folks I've spoken to, they are equally surprised that why are markets going higher and they are not volatile at all. The choppiness is missing. Even though the pace of gain has been steady, we don't have a very sharp back and forth in the market. So A, it's the price action on the upside, B, the steadiness of the price action, and C, the ease with which markets have gone up for last couple of days. There's hardly any resistance or pushback which is really coming from the bears now. So in terms of price action, trust me, if you ask anybody on the street, 9 on 10 market participants, they are surprised, some are amazed, and some are mesmerized. So what do you do in this kind of a market? This is, I still maintain, and I've been wrong in last couple of days, that this is not a market where you want to chase stocks. If you have a constructive view, which you should have, about economic recovery next year, then it is better to buy stocks when they are available at a discount rather than chasing stocks and rather than getting trapped into this entire feeling of left out or having or feeling that FOMO effect. My view, Aisha, is very simple, that markets are always driven by an unusual mix of macroeconomics, fundamentals, technicals, and liquidity. The forces, they keep on changing on a daily basis. As of now, there is a view that on the medical front, we will get a breakthrough. There is no convincing answer to that, because medical trials, till the time you don't go get a final green light, it is still suspense and it is still hope. Then there is a view that in the short term we will get a government package in India. That has not come far. But the change what I think has happened at global level is that FIs have stopped selling. So I think it's a force of liquidity and a little bit of view, little bit of hope on the medical front, which in my book is really stroking the market higher.
Yeah, because even on the global front, the economic indicators and the data points are not really any comforting, apart from the fact that Fed has said that they will continue to lend and push the economy and continue to keep rates lower for longer, will keep helping in buying assets as and when required. Besides that, the GDP print, of course, has been a shocker, which has seen a shrinkage of almost about 4.8%. Let's take this conversation forward. In fact, we've got two experts joining in on the show right now. And let's just quickly take it across to them and find out what their view is on the markets right now. Avan, you want to take that? Oh, actually, we have Stephen Innes on the line with us. I'll go across to them. And we also have Ben Emons joining in on the show right now. Gentlemen, morning. Ben, if I could kickstart the discussion with you. I guess par for the course, the fact that Fed has decided to hold rates this time around, but assured the markets that they will continue to help in buying assets as and when required. Guess that's par for the course. Ben, is my voice reaching you?
as you saw from GDP data today, there's such a contraction happening in spending because that's what we did, right? We shut off the economy. It wasn't like a business-induced recession, it's a health crisis. And therefore, in that environment of a health crisis, monetary policy plays as an emergency policy, not an economic policy, so to speak. So it's all focused on trying to keep things going as much as we can, and most of all, try to avoid the shut-off of credit in the economy. In other words, keep the credit flowing through the economy so there's no widespread bankruptcies and other types of problems. I think that was the big message today.
Stephen, would that also assure that asset classes stay afloat? There is going to be that excessive liquidity which will find its way and thereby make the US dollar as well as equities perhaps more and more dearer, as we're seeing play out pretty much.
I think that's the running narrative right now, that the Feds are going to continue having the markets backstop in some form or another. I think they made it clear. I think this was sort of laying the table, so to speak, for June. We're probably going to move into a yield curve control mechanism. And if you think they're monetizing all debt now, well, just wait for that to happen. And it'll probably send the dollar weaker, which will probably be a much welcomed reprieve for global markets. But, looking at this beyond the extraordinary policy support we've got right now, one of the main reasons really for that strong recovery in risk is just a homogeneity of the recession's driver, and that's simply compared to previous downturns that were more multifaceted, so to speak. What we're having right now is just a single recessionary input, and that's the virus. So the reason why, in my view, why the market's reacting so positive to a possible cure is it's going to cobblestone the way for a quick recovery to the global economy. And, it's not a difficult analogy to work out here. Remove that one input, we all go back to work again, and things sort of return to normal. But hey, I don't think we're going to time warp back to January 2020 anytime soon. The road literally less traveled these days, is going to be littered with potholes as we move through the summer. So I would be very cautious about owning too much risk as we move forward into the summer doldrum periods when liquidity tends to dry up.
Ben, me and my co-anchor were discussing in the morning that if you do a dipstick, forget 9 on 10. 10 on 10 market men are of the view that markets are running ahead of themselves. Do you think this consensus bearish view is the reason why markets are going higher? Because suddenly everybody is on the same side of the boat.
Yeah, I think you were addressing the question to me. So what's really happening, I think, actually, if you think about it, the way you can describe the economy through the financial markets at the moment, is you have actually three camps, right? You have a camp where the economy is currently running in a sort of an emergency engine. Their companies are really benefiting in that environment. So, for example, big tech, because so much demand for internet and other technology services. And then, of course, there's healthcare as well. And then you have the sector that is called the solution. And you saw that today with Gilead as one example, but there's other companies that is really trying to bring a solution to the crisis, and that's another sector that's really doing well in the economy. And then lastly, as we try to reopen the economy, there are sectors like leisure or hospitality that eventually will see stage a major recovery, and that is all very tentative. But it is, I think, the way the markets are currently trading towards, a better outcome over time, while there's such a tremendous policy response on the background, right? Such a tremendous policy stimulus, if you will. And I think this is all together what keeps us at the moment in this what it looks like a very risk-on phase, as we call it. But really, I think what we're doing is trying to have an economy sort of further, reprioritize, like a new type of economy where different sectors drive things and why markets are trading higher on that, as opposed to the old normal that we were used to of getting basically liquidity comes in the market and all sectors benefit. It's actually really dissected between the three that I described. Right? You have sectors that win, sectors that can recover, and sectors that provide a solution to this crisis.
Stephen, so if I'm a bull, what should a bull focus on? Do you think it makes sense to understand that markets are a forward-looking mechanism. A lot of bad news is in the price, and global liquidity will ensure that equity, both for US markets and for other markets also, will remain intact as an asset class. The reason I'm asking you this, Stephen, is because it's very hard to convince yourself that US markets are down only 15-16% from its all-time high, when we know that the damage to the world is going to be definitely more than 25 to 30%.
I'll just clarify the point here. I'm not a bull in this market. I'm equally as surprised as a majority of how quickly we've come up. I think it's just one of these situations where we had narrow leadership in the stay-at-home group and tech sector rallies, which really were getting really bought into for good reason. I mean, the stay-at-home move that we're going to see envelop the markets as we come out of the lockdown scenarios. More people are going to work at home, therefore cloud computing, et cetera, is going to be more prevalent throughout the world. So I see the logic behind that trade. But what I don't see the logic in is the asset rotation that's been going on over the last 48 to 72 hours into a wider dispersion of equity markets. To me, that presents a more fragile situation if we do, fingers crossed, we don't run into a secondary spreader with this virus that could possibly trigger a second wave of recession. And that's really the fear that I have going forward. It's just so much uncertainty at play right now that, I just think you have to be very, very cautious loading up on too much. I mean, if you're going in on one asset, you need a hedge on the other side, whether that's a currency hedge or buying into gold, something. You just need defensive strategy to buttress any aggressive investment call in this market right now, in my view.
All right, thank you so much, Ben, as well as Stephen, for taking time out and joining in, giving us a sense as to how we can read into that Fed data, as well as the news that we've seen from across the globe.